Thank you very much. It's a pleasure to be here this morning. This is by far the largest crowd I've spoken to in person for a couple of years, so it's very nice to be out in public and to talk with everyone. And in particular, one of the things that I've missed is the opportunity to get your questions, because that helps me inform me about what you're thinking, about what you're seeing. So I'm looking forward to the Q&A later this afternoon. As Dr. Oster mentioned, there is a group called the National Association of Business Economics. They date recessions and expansions in the U.S. economy. And according to the NBER, the U.S. economy had a very short but severe recession in March and April of 2020. Lasted just 2 months, very short, but a very intense recession. And the recession that we experienced last year was very different from typical recessions in the United States economy. Typically, recessions are caused by imbalances in the economy. So if we think about the Great Recession and the financial crisis from 2007 to 2009, that was caused by problems in the housing market that spread to the financial system, and many of those problems were prominent here in Arizona. If we think about the recession in the early 2000s, that was caused by the bursting of the tech bubble, or the double-dip recessions that we had in the early 1980s. They were caused by very high inflation, the Federal Reserve aggressively raising interest rates to combat that. This time around, the recession was caused by something external to the economy, the coronavirus pandemic. If I had been talking with you in January of 2020, I would have said that the economic fundamentals for the United States look good and that we expect the expansion will continue throughout 2020. Obviously, we started to follow the pandemic. As it came to the United States, it had very profound economic implications, and we had a very severe recession. The good news is that the economy is in recovery and has been in recovery for more than a year and a half at this point. That does not mean, however, that everything is good with the economy. It just means that conditions now in December of 2021 are better than they were in the spring of 2020 when the pandemic came to the United States. So the economy is still growing, but there are still problems with the economy that persist even a year and a half after the recession. We've seen a very aggressive policy response from the Federal Reserve. So they cut short-term interest rates in the spring of 2020 as the pandemic came to the United States. You can see the blue line, the yield on a 3-month Treasury note bill, that fell from basically 1.5% to 0 as the Federal Reserve cut the Fed funds rate. That's their key short-term policy rate. Then they said we need to do more to support the recovery. So they started to buy long-term Treasuries. They started to buy mortgage-backed securities. That pushed down long-term interest rates. And you can see that yield on the 10-year Treasury note fell from 2% in early 2020 to well below 1% last year. Has come up somewhat since then, but still very low on a historical basis. That's making it less expensive for businesses to borrow, for consumers to borrow, for governments to borrow. We saw that the interest rate on a 30-year fixed mortgage fall below 3%, and that supported a recovery in the housing market. The Fed is starting to dial back some of its accommodation. We'll talk about that in a bit. We've seen a full recovery in the stock market. So the stock market is forward-looking. It's not looking at conditions now on April 8th, 2021. We're looking at conditions, particularly for corporate profits, 6 months, a year, 2 years down the road. We had a big decline in stock prices in the spring of 2020 as the pandemic came to the United States. But since then, we've seen a very strong rebound. Some ups and downs, but generally strong growth in stock prices. And I think it is fair to say that the stock market currently is pricing in continued recovery and an expansion in the U.S. economy over the next few years, particularly for corporate profits. The orange line on the right-hand scale, that's the VIX index. That's a measure of how much stock prices are moving up and down. You can see that enormous increase in volatility that we had in the spring of 2020. Since then, we've seen volatility gradually decline, but still above its long-run average. We've had stimulus bills, rollout of vaccine, presidential election, the Delta variant. You can see that big spike in volatility that we've had recently with the Omicron variant. So still a lot of uncertainty out there, but I think it is fair to say that the stock market is pricing in full recovery in the U.S. economy. We've had an enormous disruption in the labor market. So in March and April of last year, we lost 22 million jobs in the U.S. economy. Compare that to the Great Recession, where we lost 8 million jobs over 2 years. So a much steeper contraction in employment in a much shorter period of time. The good news is we've added back about 18 million of those jobs. The bad news is that means we're still down by 4 million jobs from where we were before the pandemic. So we've had a good recovery in the labor market, but we still have a ways to go. And let me tell you, we got a weak reading on job growth for November, just 210,000 jobs added over the month. Ignore that. We're going to get big upward revisions to employment over the next couple of months. And then we had there's another survey that showed 1 million people hired. That comes from a survey of households. So I wouldn't pay too much attention to that weak headline job growth number that we had in November. But I said we're still down by 4 million from before the pandemic. How many of you are trying to hire but are having difficulty in finding the workers that you need? All right, is there anybody who didn't raise their hand? This is the labor force participation rate. This is the share of adults 16 and over who are either working or looking for work. And you can see that before the pandemic, about 63% of the adult population was in the labor force. Now it's less than 62%. What happened? Well, some people took early retirement because of the pandemic. Some people are concerned about the health situation and they're unwilling to put themselves in that situation, or perhaps they have a family member who is immunocompromised. Some people are having childcare difficulties. Virtual schooling, childcare centers closed. So many parents have dropped out of the labor force. And then there are people who have received stimulus payments. Perhaps they received extra unemployment insurance benefits, and they're not ready to come back into the job market yet. So we have about 2.5 million fewer people in the labor force now than before the pandemic. And that's why businesses are having so much difficulty in hiring. Now, I do expect that many of those people will be gradually returning to the labor force over the next year and a half or so, as child care centers reopen, as they spend down their stimulus payments, as they feel more comfortable going out. But it is going to remain a difficult situation for people who are trying to hire. We did see a big increase in the labor force in November. More than 600,000 people re-entered the labor force in November. I'm hopeful that that is an indication that labor force growth is going to pick up and that will help support stronger job growth in 2022, 2023. This shows 3 measures of economic activity. And in all of these, I set the peak before the pandemic equal to 100. So there's GDP, output of goods and services. That's the broadest measure we have of the U.S. economy. Final sales of domestic product, that's the green line. That's GDP minus the change in inventory. It measures demand for goods and services produced in the U.S., whether that demand comes from the U.S. or abroad. And then an alternative measure of the size of the economy, gross domestic income, that's the orange line. That is the income from economic activity going to households and businesses. So it excludes government transfer payments, for example. It doesn't include the stimulus payments that many households received last year. By all of these measures, the economy contracted by about 10% between the fourth quarter of 2019 and the second quarter of 2020. During the Great Recession, we saw GDP contract by about 4% over a period of 6 quarters. So again, a much steeper contraction in the economy in a much shorter period of time. Now, the good news is look, economic activity now broadly is above its pre-pandemic level. Those numbers are above 100, and so we've had a very strong recovery. If you look at the Great Recession, it took a couple of years for economic activity to return to its pre-pandemic level. So even with the much steeper contraction that we had in the U.S. economy this time around, there was a much faster recovery, but the recovery has lagged across sectors. So the blue bars here show the change in activity between the fourth quarter of 2019 and the second quarter of 2020, when things were at their worst. The orange bars are the change between the fourth quarter of 2019 and then the third quarter of 2021, the latest reading that we have, and all of these numbers are adjusted for inflation. So look at consumer spending on services. So this is everything from education, healthcare, financial services, travel, tourism, housing services. That fell by about 15% initially. As of the third quarter of this year, still about 2% below its pre-pandemic level, so still have a ways to go. On the other hand, if we look at consumer spending on goods, either durable goods, those are big-ticket items meant to last more than 3 years, cars, appliances, things like that, that fell by about, 3% initially, now more than 20% above its pre-pandemic level, and that's even with weak auto sales in the third quarter because of production difficulties. Consumer spending on non-durable goods, food, clothing, medications, gasoline, up more than 10% above its pre-pandemic level. So we've had very strong recovery in goods. We've had a much weaker recovery in services. And this helps explain those supply chain difficulties that we're seeing in the economy. We're simply buying a lot more goods now than we did before the pandemic, and it's taking time for manufacturers, for producers to catch up with that demand. Business fixed investment fell by about 10% initially, now about 2% above its pre-pandemic level. Residential investment in housing, so this is construction of new single-family and multifamily homes, repairs and renovations, that type of thing, fell by about 5% initially, now about 13% above its pre-pandemic level. If you're like me, you've been spending a lot of time at home, you've been noticing all the flaws in your house, we've been moving into new homes, and so with those very low mortgage rates, we've seen very strong growth in investment in housing. Government consumption and investment, that excludes those transfer payments, not much change there. Exports fell by about 20% initially, still down about 10% from its pre-pandemic level. The recovery in the United States has been stronger than in other parts of the world, although we have seen strong growth in exports lately. Imports fell by about 20% initially, now above their pre-pandemic level. A lot of the goods we have been buying have been imported goods. And again, this helps explain those supply chain difficulties, those bottlenecks that we're seeing in ports, because we simply have stronger demand and the system hasn't been able to keep up with it. Remember, I told you we lost 22 million jobs in March and April of last year. We lost all the income associated with those jobs. And yet household income adjusted for inflation went up more than 10%. Why? Because we had stimulus payments, because we had more people eligible for unemployment insurance benefits, and we increased the level of unemployment insurance benefits. So household income actually rose in the teeth of this terrible economic downturn. And that's what's allowed people to put a down payment on a new home. It's allowed people to go out and buy a new car, to go out and buy a new washing machine. And that's what's allowed for this rebound in economic activity that is underway. Now, you can see that in the third quarter, household income is still down from is down from where it was in the second quarter of last year, but still above its pre-pandemic level. So households have a lot of income. Consumer spending accounts for 2/3 of the U.S. economy, and that's what's supporting growth. And if you look at the blue line on the left-hand scale here, this is the personal savings rate. This is the share of after-tax income that households are saving. First of all, you can see that the personal savings rate, even before the pandemic, was much higher than it was before the Great Recession. So household balance sheets were already in good shape heading into this downturn. And then you can see that enormous jump in the savings rate. What happened there? Well, people received stimulus payments or extra unemployment insurance benefits. You didn't have anything to spend your money on because you couldn't go out to dinner or go on vacation. So households saved all of this cash. And you can see that the savings rate has remained elevated. We had another spike in the first quarter of this year with those extra rounds of stimulus payments. Households have about $2 trillion in extra savings saved up that they're going to be gradually spending over the next couple of years as the economy continues to improve. And again, with consumer spending accounting for about 2/3 of the U.S. economy, that's what's going to power the recovery going forward. We're also going to have very strong support to growth from inventories in 2022. This is basically the economy-wide inventory to sales ratio. How many of you either don't have enough inputs for your business, you're having trouble getting inputs for your business, or you could sell more if you had more inventories? All right. So I'd say that's about a third of the audience, and that's typically the response that I get. Inventory levels are very low right now, and businesses will want to increase their inventory so they can sell more. And as these supply chain difficulties get themselves worked out over the next 6-9 months or so, we are going to see higher inventory levels, and that is going to support economic growth in 2022 into 2023. PNC does a small business survey twice a year. This is the results from our fall 2021 survey. Strongest optimism in our survey's history. Just 3% of the small businesses that we surveyed were pessimistic about the near-term outlook for their business, so very strong business confidence. We've received enormous stimulus from the U.S. economy, about more than $5 trillion, about 1/4 of GDP. We had aid to small businesses, the Paycheck Protection Program. How many of you received a loan through the Paycheck Protection Program? Okay. PNC was one of the largest Paycheck Protection Program lenders. But that has $1.2 trillion. And many of those loans will turn into grants if the businesses meet certain requirements in terms of maintaining workers' staffing levels and pay. That aid allowed many small and medium-sized businesses to stay open through the worst of the pandemic and then expand as the economy has improved. In our spring 2021 survey, we asked those small and medium-sized businesses that had received a PPP loan, 75% said it was extremely important to their business, and then another 20+% said it was very important to their business. So almost all of them that had received a loan said it was important to their business's survival. This one-time stimulus payments that we made to households, more than $800 billion. Aid to states so that they've been able to maintain their spending, and that hasn't been a drag on growth. Extra unemployment insurance benefits. All of this has made an enormous difference in the U.S. recovery and has allowed for the strong economic growth that we're seeing. I mentioned what the Federal Reserve has been doing. The Fed, in the spring of 2020, cut short-term interest rates basically to zero and then said we need to do more support the economic recovery. So we're going to buy longer-term securities. We're going to buy mortgage-backed securities, the blue bars. We're going to buy long-term treasuries, the orange bars, and this is pushing down long-term interest rates. That's why, in part, why the 30-year fixed mortgage rate fell below 3%, why the federal government was able to borrow for 10 years at less than 1% last year. Now, the economy has picked up, inflation has picked up, the labor market is recovering. So in November, the Fed announced that they're still buying these securities just at a slower pace. And I would expect that the Fed will continue to reduce these purchases of long-term securities through the first half of 2022. That's going to put modest upward pressure on long-term interest rates. And then the Fed will start to raise their key short-term policy rate, the Fed funds rate, in September of 2022. So we will see interest rates gradually increase over the next few years, but still in the future, interest rates will be lower than they have been during previous expansions in the United States economy. So you're probably saying now, well, what about inflation? And it is true that we have had higher inflation recently. But if we look at financial markets measures of inflation, expected inflation, this is not actual inflation here. This is what financial markets are saying inflation is going to be 5 to 10 years in the future. So from late 2026 to late 2031. So who can tell me what the Federal Reserve wants to see inflation average over the long run? I heard somebody say 2%, that gentleman there. He wins the prize. What do financial markets think inflation is going to average over the long run? Just around 2%. So financial markets do not think that the higher inflation that we have seen recently is going to become embedded in the economy. And don't forget that the Fed wants to see average inflation of 2%. We've had inflation below 2% for most of the past decade, so the Fed is comfortable with inflation that is temporarily above 2%. And let's take a look at different types of inflation. So the blue line is what we call the producer price index for intermediate unprocessed goods. These are raw materials like lumber, crude oil, iron ore, those types of things. And yes, we have had very strong inflation there, but it really isn't completely out of the realm of historical experience. We've had other periods where we've also had strong inflation for these raw materials. Let's look at the orange line. That's a producer price index for processed goods for intermediate demand. So these are materials that businesses use. So this is finished steel, computer chips, finished timber, gasoline, so forth. And you can see that, yes, we have had stronger inflation there, but less than what we've seen for raw materials. And again, we've also had similar periods where inflation has been elevated for these processed goods. And then finally, this is what the Federal Reserve is most focused on. This is what is called the Core Personal Consumption Expenditures Price Index. This is everything that you and I buy every day. And don't forget, a lot of what we buy is not goods, but services, healthcare, education, and so forth. So this includes all those services prices as well. And you can see that, yes, we've had a slight acceleration in this core PCE price index, but not nearly as much as the cost for raw materials. And again, don't forget that inflation before the pandemic had been below 2% for years. And so while we are watching inflation, I do think that inflation will slow. A lot of the inflation that we have seen recently is coming from dislocations between supply and demand because of the pandemic that will get themselves worked out. New cars, used cars, rental cars, airfare, those types of things. That we will see supply catch up with demand. That will help reduce inflationary pressures. Now, we do have some higher inflationary pressures from wage gains. So I think we will see inflation at around 2% over the longer run, but I don't think inflation is going to be a significant problem over the longer run. So we have made a substantial improvement to our economic forecast since January of 2021. Even with the Delta variant, even with all the supply chain difficulties that we've seen, we've gotten stimulus, we've had a largely successful vaccination rollout, and so our forecast now is for continued solid economic growth throughout 2022 into 2023 as consumers continue to spend, as these supply chain issues get fixed. And again, our forecast still looks noticeably better now than it did in January of this year. And if you come back next year, I'll show you how my forecast actually turned out to be right or wrong. We'll see. And the forecast for the unemployment rate looks better now than it did in January of 2021. We've continued to see the unemployment rate decline. Some of that is because of weaker growth in the labor force, but the unemployment rate as of November was 4.2%. That's down from a peak of almost 15% in April of last year, and fairly close to that 3.5% unemployment rate that we had before the pandemic in late 2019, early 2020. So we do expect that the unemployment rate will continue to gradually decline over the next couple of years, even as many of the people who have dropped out of the labor force return to the labor force. But it is going to take a longer time for some parts of the economy to catch up. So I set the peak here before the pandemic equal to 100. As I mentioned, GDP is above its pre-pandemic level now. Business fixed investment is actually going to lead economic growth over the next couple of years. But we are going to see slower growth in employment, and that's typical that employment grows more slowly than GDP, particularly coming out of recessions. Slower growth in what we call industrial production, which is output of manufacturers, mines, and utilities. And then I mentioned the strength of the housing market. Housing was a big contributor to the rebound that we saw in the second half of 2020 and in 2021. And I expect that with continued lower mortgage rates, with strong demand for housing, that we will continue to see housing be a driver of growth in 2022 before fading in 2023. So there's a lot of uncertainty out there. What I'm pretty sure about is that we experienced a very steep recession last year, that the recovery will continue throughout 2022 and 2023, that we will see slower inflation next year, but that we have seen structural shifts in the U.S. economy. So we've seen a movement away from traditional retailing toward online sales. That was in place before the pandemic, but intensified with the pandemic and the recovery that we've seen. We're going to see shifts in supply chains, that businesses will keep more inventory on hand, that perhaps instead of sourcing materials from China or from India or from Vietnam, they'll source them from within the United States or from Canada or Mexico to shorten those supply chains. And then businesses will move away from having a single supplier to multi-suppliers because they've seen the drawbacks of having single sourcing. And that we're going to see shifts in commercial real estate markets. Many of us are not working at the office nearly as much. We're going to need less demand for office space, perhaps less demand for hotel space going forward, less demand for retail space. On the other hand, we're going to need more warehousing distribution space going forward. So we're going to see these shifts in commercial real estate markets. And then finally, there are some open questions out there. So now we have a new variant. We'll have to see what happens with that. Until the pandemic is more like the seasonal flu, we will not see a full recovery in the United States economy. What happens with the Build Back Better bill? The forecast that I showed you, that included the bipartisan infrastructure bill that President Biden signed in November. It does not include the Build Back Better bill. So the Build Back Better bill has some good parts to it. It has some tax increases that could be a drag on growth, that could add to demand, that could add to inflationary pressures. So we'll have to see what happens there. What's the impact of the pandemic on longer run growth? Does it cause growth in the long run for the U.S. economy to be weaker than it was before the pandemic? We're not quite sure how that's going to play out. And then finally, what's happening with the housing market? We've seen a shift away from multifamily living, apartments and condominiums, to single-family homes. We've seen a shift away from living in cities to living in suburbs or rural areas with work from home. What does that mean? Does that mean people are going to want to relocate from high-cost areas like San Francisco or the New York City areas to lower-cost areas? And that has big implications for a place like Phoenix that has, generally a lower cost of living than some of these large metro areas. So we'll have to see how that plays out as well, and that's still greatly uncertain. Going the wrong direction there. I would encourage you to look at all of our materials at pnc.com/economic reports. You can follow me on Twitter at Gus Fauché PNC. Thank you very much for the opportunity to speak with you this morning, and I look forward to your questions after lunch. Thank you.
Okay, thank you very much. And thanks to all of you for attending today. We appreciate your support of ASU. This is an important event for us. And also, I'd like to give a warm welcome to our virtual viewers, most of them at home, and I thought this picture might look familiar to a lot of you. This looks like my own Zoom room at home, with the exception that we have the added delight of the cat pan right there under my table. So one of my traditional responsibilities at this event is to give you an insider view on what is happening with ASU. And the main story right now is that we're looking forward to a brighter football year in 2022. Now, this is what Coach Edwards said at his press conference, talking about the talent coming back. This is a quote. "He's a fan favorite. He makes all the highlight reels. He's elusive in the open field. He avoids interception. So yeah, he's going to be with us in 2022. And of course, what we're talking about here is the wild fox that rattled USC to the point that they actually ended up losing the football game. Now, Bobby Hurley is interested as well. He says, "Does that fox have a jump shot?" So that's your ASU Insider Report. But we're here to talk about the economy, and I'm going to focus today on Arizona and Metro Phoenix. We do cover the western states with our Western Blue Chip newsletter, which is available on our website, and we also have some Western information in your booklet. One of the sayings about economists is that if all the economists were laid end to end, they'd never reach a conclusion. Another alternative to that is if all economists were laid end to end, that might be a good thing. In this case, sitting there listening to Gus, and we had not really conferred about this other than to make sure that we were not overlapping too much, I would have to say that we're in very much agreement on how this cycle is going to play out and also what the unknowns are, and just recognizing those. What you see on the screen is kind of your main message today, especially about Arizona and its recovery. Arizona was hard hit by the pandemic. We expect a strong recovery into 2022. We're going to replace all the lost jobs by the end of 2021. And yet, COVID uncertainty still remains as the biggest risk to the economy. Now, when we say Arizona was hard hit by the pandemic, here's the context on the screen. In just 2 months, as you heard from Gus, in just 2 months, March and April, Arizona lost over 331,000 jobs. So in 2 months, lost more jobs in Arizona than in the entire Great Recession period, which extended for a number of years. And from this little cartoon there, you can see really that job losses were off the chart. If you can't read that from the back, it says, "Thank you, Bentley, we get the picture." And he's drawing way down off the chart, and that's exactly what it looked like to those of us that were tracking the Arizona economy in March and April. We wondered, where is this going to end? But after the 2-month downturn, the economy began bouncing back, and we have added jobs in every month since. And just like your economics professor tried to tell you in Econ 101, fiscal and monetary policy kicked in a massive way. Unemployment benefits, cash payments, business loan payments, support payments of all types caused personal income in Arizona to increase by over 10%, even as the economy was losing jobs. We had an increase in personal incomes that led then to an increase in retail sales, partly due to the fact that the stock market was also surging at the same time, given an increase in wealth and income. We're expecting about a 20% increase in retail sales for 2021, and that is going to be reflected not only in higher retail sales, but also in higher retail tax collections. So we have income up, we have retail sales up, and therefore downtown at 1700 West Washington Street, we have tax revenues up, sort of an ironic state surplus while we are still in the process of coming out of a pandemic. Now, things are not back to normal, of course, and one way to measure this is to look at if people are willing to venture outside their home. At the worst of the pandemic, going back to April of 2020, we saw that time away from home fell by about 20%, meaning people stayed home. Time spent in retail shopping or restaurant shopping or restaurant service fell by 40%. They are still down, but only about 5 or 6%, but still have not recovered from the pandemic effect. Now, this chart is based on data from Google, and really, there's two conclusions. First, if people are spending a lot of time at home, they're probably spending a lot of time online, and they are probably buying a lot of stuff, and that is one of the factors that is affecting supply chains nationally and globally. Second, this chart also reminds us that Google somehow knows where we are and what we are doing. And that's another issue to worry about, I think, but maybe at another time. So as of right now, we are on track to replace all the lost jobs by the end of the year. The prior peak was in February of 2020. There's a good chance we're going to see an all-time high employment in Arizona of 3 million by the end of the year. Here's our forecast table, a bunch of numbers here, and I would just call your attention to that far right column, 2022. What we're seeing is job growth expectation of 4%. It's about 100,000 new jobs. If we hit the 100,000 new job mark, that will be the best year for job growth and the first 100,000 job year since 2006. And what I'd like to do then is just kind of pick up on this table and work through some of these indicators, starting off with employment. What is driving employment recovery in Arizona? It is the service sector. We added about 93,000 jobs so far this year. 80% of them came from these 5 service industries: food service, transportation and warehousing, retail trade, professional and technical, and healthcare. That's what's driving the Arizona economy right now. When you look at where we are in 2021, 2022, compared to a very strong expansion over 2017, 2018, that era, you can see, in fact, that this, again, will be a stellar year for job growth if, in fact, this forecast is realized. You heard from Gus that the national labor force has still not returned to pre-pandemic level. That is not the case for Arizona. In Arizona, in the first quarter of 2020, first quarter of 2021, we recovered all the lost employment, labor force, employment and unemployment, that makes up the labor force. The labor force returned to its prior pandemic level and has been increasing ever since. So we are in a completely different situation here in Arizona, largely because people keep moving to the state, but we also have people that have been on the outside, the fringe of the labor force, coming back into the labor force seeking work. So this is an important issue, and a lot of economists have actually gotten tenure by studying quit rates, labor force, and I would just suggest that you can tell if you're taught as a future economist if they come into your bedroom and say, I had another bad dream about the labor force recovery rate. Be on the alert for that. Let us know. Okay, looking at population. Population is a driver of the Arizona economy. Compared to 2010, the 2020 census showed that Arizona ranked 9th among all states in the rate of growth. And the important thing to note here is that regionally, you look at the brighter green showing the stronger growth, you can see that the economy is driven by Western growth, Southeastern growth. That is the way economic growth has been in the U.S. For the past 50 years or so. When people move, a lot of people move to Arizona and they need housing. Also, because of COVID, we have the side effect of people working at home demanding either more space, or if they've been in an apartment, perhaps a permanent home, or if they have the flexibility of being able to work at home on a permanent basis, they might move and be in the housing market. All those things have driven up home ownership in Arizona, which had been declining and then slowly recovering around 2015. So the home building industry is responding. We are looking right now at about a 20 to 25% increase in single-family permits for 2021, and we expect that to extend into 2022. So home building is back. Now, this is not the same 80,000 single-family permits that we saw in the housing boom period of the mid-2000s, but it is a steady, sustainable trend, I think, in home building that is beneficial for the Arizona economy. Looking at the Phoenix forecast, you see the same kind of expansion. Looking down that right-hand column, you see over 90,000 jobs to be added. Single-family permits, multifamily permits are going to continue quite strong. And your tagline across the top of that table, Phoenix is among the strongest metro areas in the nation. Let me just give you some of the metrics that relate to that. We added 77,000 new jobs in Phoenix so far this year. Our growth rate here is fourth among all large metropolitan areas. The job creation in Phoenix over this period is greater than 35 states. What is going on right now in Phoenix in terms of employment creation accounts for 90% of Arizona activity. Nationally, we rank third in the nation in the transportation warehousing job growth creation, and we're third in professional and technical growth. So we're becoming a regional, if not national, distribution center and continuing to grow as a technical center. So the Phoenix economy has continued to move away from the reliance on only real estate and is much more diverse than it was before. Now, there's a lot of concern about inflation rate. Strong demand generated by high incomes, high savings, high wealth, growth, stock market, and so forth, has increased demand, whereas supply has been restricted by certain constraints. The result has been that we have inflation and had some startling numbers for Phoenix inflation, 7% year-over-year inflation growth in Phoenix in October. And same kind of issues as you see at the national level, used cars, 25% inflation rate, gasoline over 40% inflation rate. But what is important to recognize, and perhaps has not been highlighted as much, is that if you look back to January 2020, yes, you can see that inflation has increased the consumer price index by 8.2%, but over that period, due to labor shortages, due to an expanding economy, average weekly wages in the Phoenix area are actually up over 12%. So what this means is that in spite of inflation, higher prices, we still have an expansion of purchasing power as well. Home prices have been making headlines as well as inflation. You're probably familiar with this. Phoenix home prices, according to Case Shiller, are up 33% year over year, the most of any large metropolitan area. But again, there's kind of a second side to the story. If you compare Phoenix home prices with other major Western metropolitan areas, we are actually very, very competitive. Phoenix home prices, according to Zillow, for October were $474,000 for homes sold. That, in fact, is lower than Austin, Riverside, Sacramento, Denver, Seattle, not as low as perhaps Dallas or Las Vegas, but just in terms of people in California, people in most other Western states looking at alternative living situations, looking at places to move their business, looking at places to relocate. Again, especially from California, Phoenix remains very, very competitive. One other thing that I think we ought to recognize as well, shown on this chart here, if in fact we'd never had the housing bubble, imagine there's no housing bubble. Instead, imagine that home prices had increased from 2000 to now at about 4.9%. We would be exactly where we are right now. But we never would have had all the anguish and kind of false elation associated with a big surge in home prices, a collapse in home prices, a recovery in home prices. But you could very easily make the argument, I think, that this trend line and this point where we are right now may in fact be completely appropriate for this economy, this population, this region. And that is why it is very likely that there will not be a downturn in home prices, but instead prices will revert to some sort of kind of steady growth over the next year or so. And again, I would say what's that going to be? 4.5%, 5.5%, 6%, not going to be 33% month after month. I think we can be sure of that. So overall, I think you get the message that we expect solid growth in 2022. There are risks, COVID uncertainty, supply chain, housing affordability, climate effects, Washington, D.C. I'm going to kind of leave that for Larry Summers to discuss, but as pointed out by Gus, there's some things where we simply don't know how those issues are going to affect economic growth going forward. But we can summarize Arizona, I think, in a very optimistic, positive set of points. We're in a pro-growth economic setting, and I don't think anybody would argue that. We have a competitive tax structure, available industrial space, labor, relatively new infrastructure that is, I think, on the verge of actually being improved by all of these various federal programs coming down the line. I think everyone would agree we need to continue to work on education issues. We really shouldn't be in the bottom half of all states, no matter what education indicator you look at, okay? Maybe we're not going to be number one. Maybe we don't want to be number one in terms of spending, philosophy, and so forth, but this is a state that ought to be in the top half, I think, of education rankings, not lower half. And finally, that ties in with a frequent comment, a critique really, that I hear from people, and that has actually been written up by critics and so forth. They say, these numbers look good, but you don't talk about the important social issues. So I've chosen today to close by just picking one, and I hope you can help me maybe with some suggestions here. There are street gangs that are slowing down deliveries and construction, and I think that we need some resolution of this. There's been one I received is build a wall. So shoot me an email if you've got any thoughts on that. Thank you very much, folks.
Hello, I'm very glad to be with you. Somehow the camera doesn't permit me to see the ballroom, but I'm very glad to be with you in spirit. I should say that since my wife decided a year or two ago to retire from Harvard and move to head Arizona State University's Center for the Public Humanities under the influence of your dynamic president, Michael Crow, I have become very enthusiastic about the state of Arizona. My wife and I have bought a house in Scottsdale, and in fact, we will be coming out very soon for about 4 months. And so I hope I'll have an opportunity to meet with many of the friends of Arizona State who are in the room. And I should say also that I've long been a professional colleague, though we haven't already always agreed, with Arizona State's economics Nobel Prize winner, Ed Prescott. And I've got great respect for him and for the other members of the ASU economics community. And I should say also that I'm very grateful for that very generous introduction. It wasn't so long ago that I was introduced by someone who said, "Larry, do you know what it takes to succeed as an economist?" And I said, "No." And I was told that an economist is someone who's pretty good with figures, but doesn't quite have the personality to be an accountant. I recovered from that, but it was in Moscow. And what was really interesting was that in Moscow, no one got that joke. What I'd like to do this morning, this early afternoon, is talk about what I've been most worried about for the last few months, the threat of inflation. Talk about the challenge of appropriate monetary policy and the challenge of appropriate fiscal policy for the relatively near term in the United States, and then talk about two longer term issues: secular stagnation and savings absorption, and achieving effective, competent, and confident governance that I think are ultimately most important for the long run. So first, inflation. I believe that the United States has made consequential policy errors over the last year. Coming into this year, a reasonable guess was that the economy was going to, through the year, average being 2 or 3% of GDP, short of its potential to produce. Another way to say it is that incomes of households were going to be perhaps $30 billion a month short of where they would have been in the absence of COVID. So we had a 3% of GDP gap. We had a $30 billion a month or $360 billion income gap. And what did we do? We provided $2.8 trillion or 14% of GDP in stimulus. Some of that was in the bill that passed in December, about $900 billion. And then the American Recovery Act was about $1.8 trillion for a total of $2.8 trillion or about 14% of GDP. It was predictable, in my view, and predicted by me, among others, that when you tried to fill a $30 billion a month gap with $225 billion a month, when you tried to fill a 3% of GDP gap with 14 or 15% of GDP, when you did all of that, at the same time that monetary policy was setting interest rates at zero, the Fed was rapidly growing its balance sheet, and households were dealing with a substantial savings overhang, that you would get a massive expansion in demand, and that massive expansion in demand would translate into inflation. Probably there'd be more inflation if there were more supply shocks, but even without supply shocks, the level of demand was disproportionate to the likely capacity of the economy to produce. That analysis has been borne out essentially in full over the succeeding 10 months. Today, we are looking at an economy where house prices have risen by 20% on owner-occupied measures and on rental measures as well. But most of that, probably 3/4, has not yet shown up in the CPI. We are looking at, and there were new figures on this morning, the highest rate of job vacancies, the highest ratio of job vacancies to numbers of unemployed people since the statistics were calculated. We are looking at another sign of labor market tightness, near record high levels of quits. And so you add all that up, and of course, you're looking at the CPI having risen 6.2% over the last year and having risen at an 11% annual rate over the last month. You're looking at measures that pay attention to core inflation, measures that look at the median component in prices as going up quite rapidly. The figure on the employment cost index that came out yesterday suggested that over the last 4 quarters, it had averaged 6.2%. So all indicators are, in my judgment, pointing to inflation well in excess of the Fed's target inflation rate of 2% going forward. Whether or not some of the inflation is transitory, I'm sure it is. I'm sure that a year from now, the port at Long Beach will be less congested than it is today. I imagine other areas of shortage, like used cars, will see the shortages alleviated over the next 12 months, if not over the next 3 to 6. On the other hand, the labor shortage will have fed through further into higher wages. The level of inflation coming from house prices will have manifested itself in the consumer prices. So I think right now we are looking at an economy that is really quite strong, but an economy that is in substantial danger of overheating. The best bath is a full bath, but a bathtub that's overflowing is a real problem. And that's the way to think about the American economy right now. Second, what does this mean for monetary policy? I welcomed Chairman Powell's decision to retire the word transitory. I was glad when Secretary Yellen echoed the conclusion, making clear that she now recognized that significant inflation was going to be with us for some time to come. What I think is not adequately appreciated in monetary policy discussions, at least some monetary policy discussions, is that monetary policy has become very substantially looser over the last year. Perhaps the best single measure of the tightness of monetary policy is the 1-year real interest rate. A year ago, nominal interest rates were essentially zero, and prospective inflation rates were below 2%. Today, nominal interest rates are close to zero, and prospective inflation rates are close to 4%. So we have seen real interest rates decline by between 1.5 and 2 percentage points. Given that, it's not surprising that indices of financial conditions that take account of short rates, take account of long rates, take account of credit spreads, take account of foreign exchange, take account of the stock market, suggests that financial conditions are looser today than they have been in the last 30 years. There's no justification at a moment of unprecedented labor shortage, at a moment of substantially above target inflation, for epically easy monetary policy on any standard measure. I therefore believe that it will be appropriate for the Fed to rapidly adjust monetary policy. There is no continuing justification for growth in the central bank balance sheet, and it should be phased out as rapidly as possible, certainly by the end of the first quarter, and for mortgage-backed securities, perhaps immediately. The Fed should signal with respect to monetary policy that its primary concern is not some kind of slowing of the economy, but is economic overheating. The Fed should signal the plausibility of 4 or more interest hikes in 2022, and should make clear that it sees normalization of financial conditions as a critical priority given economic strength. What about fiscal policy? The fiscal policy that we have pursued in the last year has, as I've explained, been, in my view, quite unwise. We have provided a great deal of economic stimulus to demand with the various tax credits and support programs for households, while at the same time not doing much at all to enhance the supply side of the economy. It is true that the size of the budget deficit, the fiscal impulse, is likely to be negative between 2021 and 2022. How much that will constrain overall spending is not entirely clear to me. There's fairly abundant anecdote suggesting that households saved for many reasons in 2021, and much of that saving may be spent in 2022. There is the further point that a certain amount of paying down debt in 2021 is now being followed by running up levels of debt as credit card applications, for example, reach near record levels. What does this mean for fiscal policy going forward? Here I find myself with an intermediate position. There are those who believe we should not engage in significant new public expenditure no matter what. I don't think that's the right view. I think we're a better country if we're able to collect taxes effectively. I think we're a better country if we're investing to support an energy transition that greens the economy. I believe it's kind of insane that it takes 20 minutes longer to fly from Boston to Washington than it did when I started making the trip 40 years ago because of a decaying infrastructure. I believe it's a moral outrage that American children are losing IQ because of lead in water that has gone unaddressed. So I believe that it is appropriate that we make very substantial public investments in the future of our country. But I also believe that as we make those investments, it is enormously important that we do so as efficiently and as effectively as possible. I also believe that it is crucial that we pay for those investments with new revenue increases so that they're not on net providing a further stimulus to demand. And I believe that measures that operate to raise costs and promote inflation, such as the provisions that call for a higher electric car tax credit for cars that are produced with union labor than for cars that are produced without union labor, are inappropriate. If, as this bill finds its way through the Senate, we can have reasonable confidence that spending will be offset by revenue increases. If there is an emphasis on expanding the supply capacity of the economy, I believe it's important to remember that the proposed legislation under discussion is considerably smaller over 10 years than we experienced in fiscal stimulus in 2021. So I strongly support, not because I think it's necessary to stimulate the economy, but because I think there are public investments that are necessary to create a fairer and a more competitive society. My best guess is that after a long and complicated process in which your own Senator Sinema will no doubt play a crucial role, I am guardedly optimistic that a bill of some kind that emphasizes this theme of public investment will pass through the Congress. More briefly, I want to address two other issues. A major anomaly in markets is the extraordinarily low level of long-term interest rates. Markets are now expecting that real interest rates, that is, interest rates corrected for inflation, will be well below zero between 2026 and 2031. That is a surprising thing, given that at that time it is anticipated that US budget deficits will be really very large, and that the US will, by that point, have accumulated well over 100% of GDP in debt. What is going on here? I don't think anybody knows. To some extent, my view is that there's a trading opportunity here because markets are not right. Although, as Keynes famously cautioned, markets can stay wrong longer than people can stay solid. I also believe, though, that there is a market judgment that we will return to the kind of situation that played out after the financial crisis and also played out in the latter half of the Great Depression. And that is a situation where there is a structural excess of saving. That structural excess of saving will puts downwards pressure on interest rates. It leads to upwards inflation in asset prices because of the low interest rates. It reflects an abundance of saving relative to investment opportunity, and therefore a dynamic in which savings finds its way into existing capital rather than into new opportunity-based investment. I think that kind of secular stagnation dynamic with inflating asset prices but limited demand and limited growth that we saw in the post financial crisis United States, and that in some ways we've seen in Japan for a very long time, is, I think, a very, very important risk. Final comment, and it's really a comment of political economy as much as it's a comment of pure economics. I think a great deal depends on whether the United States is able to restore confidence in its government at home and abroad. We are now facing severe global challenges from China, from Russia, and from Iran all at once. Our allies worry that whatever we may say now, we may say something different after the 2024 presidential election, or perhaps we'll say something different before an even shorter time after somebody consults with the Congress. At the same time, the fraction of people in the United States who believe that the government can do a good job in educating their children, who believe that we will be successful in dealing with the infrastructure, is far lower than it once was. And so the challenge that I think is before all of us, whatever our precise convictions on a range of policy, is to find ways of fostering cooperation so that people believe it makes sense to have debates about what the government should do, because the government will actually do what it says it's going to do and will be capable of achieving, for better or for worse, the objectives that it sets for itself. That after decades of debating the appropriate role of government, it is also essential now to focus on the appropriate function of government at a time when that has been called into very substantial question. Let me conclude where I began. It's a great privilege to be with this very distinguished group. I look forward to returning in the audience on other occasions, and I'm delighted to discuss any aspect of the economic situation that's of interest to people who are convened for this gathering. Thank you very, very much.
Larry can hear us. Okay. I have many questions here, so I'm going to do my best to distribute the questions in a fair way. So, in the screen there are two questions that should go to Larry and Gus. I'm going to read them. Question one is, given all the expenditures we have committed to, taxes should go up. Question, what taxes should go up? Question two is, budget deficits are large and expected to grow, and the same is true for unfunded liabilities due to population aging. The question is, for how long can a fiscal consolidation be delayed? So, Gus, you want to start?
I suspect a fiscal consolidation can be delayed somewhat longer than most people suspect. Here's a way of thinking about this. When the Maastricht criteria were developed in the Dutch town of Maastricht in the early 1990s, those criteria said that a country should not run a debt to GDP ratio greater than 60% and should not run a deficit to GDP ratio greater than 3%. On the other hand, when those criteria were developed, the interest rate in Germany, which was the lowest in Europe, was 9%, and the real interest rate in Germany, which was also the lowest in one of the lowest in Europe was 5%. Today, we're looking at an extraordinarily different world in which the nominal interest rate is close to zero and the real interest rate is materially negative. And so the level of debt that can be sustained is, I think, significantly greater. So I personally am more concerned, much more concerned than most, about the inflation risk that comes from all of our efforts to stimulate demand. And I am less concerned than many of my friends about issues around fiscal sustainability, where I think where there's a will, there's a way, and the government will be able to meet for the foreseeable future its fiscal obligations, given how low interest rates are, and even making allowance for some possible increase. Would I like to see more revenue? Yes. How should we get more revenue? The best way to get more revenue is to enforce the tax law we have. $7 trillion tax gap over the next decade. The Biden proposal is a very good start. It will devote $80 billion to this. And I think it's reasonable to expect that there will be at least a 5-to-1 return in terms of increased revenues. You could do better than that if we were prepared to treat people who put cash in banks like people who put wages into banks and require reporting on those deposits. I think that would catch a great deal of problematic tax behavior. I don't think there's any reason at all why the United States can't afford a 25% corporate tax rate, given how low costs of capital currently are. And I have to say, as a Democrat and as a progressive, I am personally pleased, but publicly appalled that despite the fact that I'm someone who's in a position to buy what my wife and I think is a very nice house in Scottsdale, that the current tax legislation is more likely to reduce my taxes than it is to increase my taxes. So number one, tax enforcement. Number two, corporate tax increases to what was business's desired level before President Trump's election of about 25%. And number three, further increases in rates for high income people and for addressing a whole set of inappropriate tax loopholes like carried interest.
Gus?
Yeah, so I generally agree with Larry about the fiscal sustainability issue. With very low interest rates in the United States and internationally, that makes it easier for the federal government to carry larger amounts of federal debt. And I do not think that we face an imminent crisis. We need to make smart decisions over the longer run. We still have issues related to the retirement of the baby boomers and rising healthcare costs that we need to address. But we are not in imminent threat of a fiscal crisis. And then I also generally agree about the calls for taxes, but I think the obvious other avenue for tax increases is a carbon tax. We are dealing with a very severe problem in terms of climate change. We need to address that. And one way that is cost effective in doing so is to raise taxes on production of greenhouse gases. That would reduce businesses' incentives to produce those gases. It would reduce consumers' incentives. And so I think that if we're thinking about ways to increase revenues over the longer run, that's the big avenue that I would look at.
All right, thank you. So here's a question from Frank Ramsey. It's a question for, I guess, the three of you. How to fix the supply chain issues in the short run? Is there anything the government can do or should do? Larry, you want to start?
Yeah, look, I think the government's doing the right thing by trying to reduce the backlogs in the ports. I think on balance, the release of the Strategic Petroleum Reserve will probably mean modestly lower oil prices than we otherwise would have had. I think the moves to promote more availability of oil and natural gas are probably mostly welcome. But I don't think any of it's hugely important. I think that we should reduce tariffs because many of the tariffs we're putting on are, from the point of view of the economy as a whole, self-inflicted wounds. They mean higher prices for consumers, and more important, they mean higher input prices for businesses that are involved in international competition. So I'd like to see tariffs going down, and I think that would contribute to raising supply. But I think realistically, the major tools we're going to have to control inflation are going to be the management of demand and the restoration of credibility, which I think has taken some blows in the last year or two.
I would add a couple of things. I think the first thing the government can do to deal with some of these supply side issues is get the pandemic under control. If people feel comfortable working, if people feel comfortable sending their child to childcare or to school, then that will go a long way towards increasing labor supply, and that's one of the big hangups that we're seeing right now. So getting the pandemic under control is the first thing. And then also, we're economists, we think that prices actually work. And so that higher prices send signals that businesses need to come up with ways to, innovations that allow them to take advantage of these higher prices that they can charge for their goods and services and get them to market. So I'm concerned, and not that we've seen a lot of this, but we should operate under the assumption that prices will do a job in effectively allocating labor, transportation, all of that, and allow those prices to result in stronger supply, higher wages result in greater labor supply, and so forth.
I would just suggest that we also might encourage a trend that's been underway for quite a while relating to our neighbor to the south, Mexico. One of the issues, of course, is that we have very lengthy supply chains, especially involving the Asian nations, the necessity of unloading at ports and all the constraints associated with that, whether it be truck drivers, equipment, union rules, and so forth. But over time, we have seen more and more outsourcing to Mexico, and I would suggest that if we encourage more of that, this would be a benefit not only to Arizona, I think, but to U.S. manufacturing in general.
If I could just make 2 points. The first is that I share the view on the importance of international integration. In general, I think our tariffs have, to an important extent, been self-inflicted wounds, and we're better off getting rid of them. And one of the reasons we're better off getting rid of them is that it will lower prices and also reduce inflation. I am quite unsure about the effects of pandemics on inflation. The Fed during 2020 explained that because we had a pandemic, there would be losses of confidence that would lead to less spending, and so it was necessary to have extremely easy monetary policy. I'm not sure that we can take that position, and we can also take the position, because the pandemic was deflationary, I think it's a bit problematic to also take the position that the end of the pandemic is going to be deflationary, and I'm not sure that it will. Yes, more and more people will come to work, but they will be paid and they will spend and they will necessitate new investment on their behalf. So I am far from sure that a more rapid move with respect to COVID and more progress more quickly, whether that will be inflationary or not, I think is very unclear.
All right, thank you. So here's another question. So the Biden administration has doubled tariffs on Canadian lumber. It has not reverted the Trump's trade policies. The question is the U.S. permanently becoming more close to trade? That should be a question for both Gus and Larry, I think.
I think these things go in waves. I continue to believe that there's a long-term trend towards greater openness in the global economy. I think it's driven in part by all the things that information technology is making possible, that enable production at a distance, that enable outsourcing call centers to other countries, all of the kinds of things that we have read about. I think measures like the softwood lumber measure are shooting ourselves in the foot. We're hurting our home building industry just when that industry is very important that industry grow. We're pushing up prices relative to what they otherwise would be just at a moment when that's probably not what is indicated.
Let me add, I agree with what Larry said. I would raise a couple of other points. This is not just a U.S. issue. This has been a global issue. We see it with Brexit. We see it with China turning inward and so forth. So to say that this is just a U.S. problem, I think, is short-sighted. The second thing that I would add is, and sorry, I lost my train of thought there. So Lee, if you want to add anything.
Trying to pick up your train of thought, but no, I have nothing to add. Thanks.
I have a question that goes directly to Lee here. It's a good one, I think. Who are the new migrants to Arizona and Metro Phoenix? Any sense of who the newcomers are in terms of their socioeconomic characteristics?
This is an important question, and it's an issue that we track with data from the Census Bureau. Obviously, California is the #1 source of newcomers to Arizona. What is interesting is that you would think that there would be some sort of outflow, perhaps over time, from Arizona to Texas, just in terms of housing price differentials, factors such as that. It is interesting to track Arizona outmigration, say, to Washington State, to Texas, to Colorado in particular. And what you find is that there's outflow, and then there's almost equal inflow from those same states. But certainly the mothership for Western migration is California. And I don't know if you directly recall the leading states for growth from 2010 to 2020 on the map we looked at. California was not one of them in terms of growth rate. They're also not #1 in terms of new residents. The #1 state is Texas. Arizona was #8, I believe, in absolute inflow. So we look to California. We look to some extent to the Midwest. And what we tend to find is that on average, the people moving to Arizona, looking at income categories, for example, are actually leaving behind areas where those individuals have higher income, and they come to Arizona. And the effect of that then is that, as a somewhat of a generalization, the migrants into Arizona are not lower income, lower skill, but in fact are more middle income and more likely to buy housing at a higher price and higher quality than what they left behind if they came from the Midwest. When they come from California, obviously, the housing they left behind is higher priced. than what they bought in Arizona. And that, of course, is the main driver for California relocation, cost of living, quality of life.
Thank you. Here's a question for the three of you. Should the U.S. pay people to get vaccinated? Yes or no?
No. Most people are going to get vaccinated and you'll end up paying them. And so the extra cost per vaccinated, per extra vaccination you generate, I suspect won't be very large. I suspect will be very high. And I think more generally, one shouldn't be paying people to do what is a reasonably understood civic duty that is massively in their interest. So I would rather not have the government be in the position of paying people, at least in normal circumstances. I would have the government obviously be in the position of providing vaccination at very low cost or free. I would have the government be involved in making sure that even for those with mobility issues or those in remote areas, that viable vaccination options are available. But I would not be inclined to support paying people to get vaccinated.
I guess this is more of a political argument than an economic argument, but I'm concerned that vaccines have already been incredibly politicized and that paying people to do so would just increase that politicization around vaccines, and that could actually deter people even more. So, my wife's a physician who's been heavily involved in vaccine efforts. If you haven't been vaccinated, please go out and get vaccinated. But I don't think the government stepping in is going to help alleviate that problem.
Lee, your turn.
Yes, it seems like somewhat of a bizarre proposal. I think, however, kind of extending that idea, I do notice, just from reading Economist magazine and so forth, that other nations have been much more liberal and effective at testing and providing free testing and extensive at-home testing. And I would think that that would be something that the U.S. Should be looking at more extensively. I recall President Biden said something about, making free testing available, but, as far as I know, that would be some kind of insurance reimbursement and so forth. Many other nations have a system whereby you just pick up a packet of 5 free tests or something, and I would think that that would be something that would have some benefit.
Good. Here's a question I would say also for the three of you. Lee can intervene here because, he knows a lot about immigration, living in Arizona and thinking about Arizona for a while. Question. Immigration levels are sharply down relative to 4 or 5 years ago. What should be the U.S. policy in this regard?
I'll jump in first. I am a strong proponent of higher levels of legal immigration. We are seeing much slower natural population growth in the United States. We've seen birth rates decline. We're discussing labor shortages here today. One way to help alleviate those labor shortages over the long run is to bring in more legal immigrants. We can have discussions about what's the appropriate skill levels and so forth, but I think that significantly higher levels of legal immigration over the long run are going to be very important for United States economic growth.
Let me just add to that looking at the numbers, just ballparking, it would be in the range of 400, 500,000 persons per year that we have not seen enter the labor force over the last 4 or 5 years. And so that has had an effect on the size of the labor force.
Larry?
I'd be in broad agreement. I think that immigrants do an immense amount for our country. I think there's an idea that immigrants are huge competitors for American workers. I think in many cases they're complementers rather than competitors for American workers. I think of the huge amount of energy in Silicon Valley that derives from immigrant entrepreneurs. I think about the many areas of the country where meals are served in restaurants or lawns are mowed by people who came temporarily or permanently from other countries. And I think if we had more of that, we would have a better functioning economy.
All right. Here is a question for both Gus and Larry. What are, in your view, the biggest headwinds ahead of the U.S. besides COVID?
I think we've got some real challenges in the level of financial markets and of achieving a soft landing along the lines of what I described a little earlier. I think we have substantial challenges with respect to our infrastructure broadly defined for economic growth. That's why I think some version of the president's Build Back Better legislation is so important. I think we have a substantially and harshly divided country, which makes it more difficult for us to give assurances to foreigners and makes it more difficult for us to come together to solve common problems. You know, we can't be proud of the number of people who have died of COVID. And so those questions that aren't always the most glamorous questions about how effectively government functions are, I think, very, very important.
Let me add one more thing to that list, which is I think the international recovery has been weaker than has been in the United States. Larry's been talking about all of the stimulus that we've received here in the United States and how that's causing overheating. It's generally the opposite problem overseas, where there has been less monetary stimulus, less fiscal stimulus. So as I showed earlier, we still have exports from the U.S. That are well below their pre-pandemic level, and so that until we see stronger growth overseas, I think that's going to be a drag on the U.S. recovery over the next couple of years.
Good. I have a question that I think is going for Lee here, which is almost like a classic in the last years. How big of a threat is global warming for the growth of Metro Phoenix?
I know this will sound like I've planted this question because last year I began 2 years ago, this same question, well, it would actually be 3 years ago because we didn't really meet. In any event, this question was raised about 3 years ago at the same event. And I was very blasé about my answer about the capability of technology to solve all our problems, and that climate change effects are down the road, et cetera, and so forth. So this was could have even been 4 years ago that I answered that way. 2 years ago, after having had an opportunity to think about that and do some of my own research, I became aware of a body of researchers that right on ASU campus that are working on the understanding the possibility of a heat Katrina for Phoenix. And this is an issue we have come back to from time to time. It's something that perhaps B movies are made of. But what happens is that we have 122, 124 degree weather that settles in. It settles in for 2 weeks. The utilities are incapable resolving the demands on energy. People begin to try to move out of the urban area. As you know, you want to head to Flagstaff on a normal weekend, you're going to run into a terrific snarl of traffic. And among other indicators, data points, and so forth that I looked at as we were thinking about this, is to discover that the number one cause of deaths due to natural events are due to heat. Heat is the number one killer of, so I think that there is a potential here for a very serious problem in terms of a kind of a spectacular, horrible event, a Phoenix Katrina. And in addition to that, of course, we have the normal long-term problems here. We really need to deal with the water situation. We need to have a sustainable economy. We have a lot of good people working on this. And so my optimism about the ability of technology to resolve this set of problems related to climate affecting Phoenix in the long term is still there. But this other issue, the possibility of a Katrina-type heat wave, as I say, people are working on that and thinking about it at ASU. I can give you the contacts if you're interested.
Okay, good. I guess we have time for more questions. Do we have time? Okay, I'll put one more. This is for Larry and for Gus. What if Russia decides to invade Ukraine? What economic effects should we expect?
It won't be good. I think the largest effects are of two kinds. I think you're likely to see some substantial increase in natural gas and energy prices in Europe because of the consequences for transmission channels and for the Nord Stream pipeline. And I think you're likely to see some substantial increase in risk premia everywhere, just because there'll be greater geopolitical uncertainty and less sense of what's going to happen next. But my guess is that that's an event that will have far more consequential events geopolitically than geoeconomically. While I don't remember for sure, I would be surprised if history showed that the Russian invasion of Crimea was a major market event.
And I would just agree that I think the biggest primary effect is going to be through the effect on energy markets. We are starting to see oil prices, natural gas prices come down, but if that were to happen, that would result in significantly higher spikes and higher inflation.
All right, I think that was our last question. I want to thank everybody for participating. I especially want to thank Larry for joining us. Thank you, Larry.
Thank you. It was a real pleasure to be with you, and I look forward to arriving in about a week in the Phoenix area and seeing people in business settings and in golf settings.
Very good. Thank you. Thank you all.